Ramblin' Ray, newbie question here. Assuming profit margins are good, how much funding should I set aside for reserve repairs on a move-in ready property? I'm in the Dayton area. I think that's a good question. What I would suggest is you're going to see a lot of websites, books, other people talk about setting aside 10% for capital expenditures and 10% for repairs and maintenance. And I think that is extraordinarily silly and unrealistic because these capital expenditure items don't care about the percentage that you're setting aside. So if you need a new roof and that's going to be $5,000 and you're sitting there with a property rented out for even $1,000 a month, your 10% for capital expenditures is going to be $100 per month. That's 50 months of 10% that you're going to need, assuming nothing else goes wrong. That's going to get you in a little bit of a predicament. So I see a lot of people analyzing properties, putting that in there and thinking that they're being extraordinarily conservative and that they are, preparing for the worst by doing that. And I think that's a bad way to live life. And even like from a pragmatic perspective, when people do put that 10% aside for capital expenditures or repairs and maintenance in their analysis, they don't have a corresponding bank account that is receiving that 10% for capital expenditures or that 10% for repairs and maintenance or that 4% for vacancy. So if you don't have those bank accounts and you don't have a reserve, I think you're just fooling yourself and thinking that you are being conservative and doing the right thing. So while I definitely think you should put money aside on a monthly basis, I think from like a worst case scenario would be not having insurance and experiencing a total loss, right? So anything short of that is not worst case scenario. But I think being conservative and planning for the worst and also being prepared, I think having enough in reserves to replace two of the largest, most costly items on that house is a sufficient reserve to have for that house. So if a roof is going to cost $5,000 and a furnace is going to cost $4,000, then I would want at least $9,000 set aside for that house. And then I would just really hope that both of those things don't happen at the same time. But I think that is a good way to figure out how much money to set aside and be comfortable with it. And I would also say that this is a little bit malleable, and depending on the property, if you know it well, I would budget accordingly. So we have a couple of properties where we know that there are 3 layers on the roof, the original cedar shake shingles underneath, and that's going to be a $11,000, $12,000 roof whenever that time comes. That would make me want to increase that number from that 5,000 that I just said to that 11 or 12,000. Also, if you know that you have a new furnace, but the kitchen cabinets are really on the fritz, and that new kitchen is going to cost $6,000 or $7,000 when it's time for you to replace it, then I would go ahead and not worry about the furnace, and I would go ahead and budget for the kitchen to be replaced, and I would use those numbers to factor in your potential reserve. That's a framework that I am significantly more comfortable with than the industry standard, yet, in my opinion, horrible advice of setting aside 10% for capital expenditures, 10% for repairs and maintenance, and 4% for vacancy. Each time we start talking about this, I'm really tempted to go in more detail and discuss that when it comes to real estate investing, the real difference and the real profit centers come from quantity. So the more properties that you own, the easier it will be to take care of all the properties that you own. And I think it's borderline impossible to make enough money to justify owning one rental property. I think you really need to benefit from the law of large numbers or the law of averages, whatever you want to call them. Because essentially, if you are going to take good care of a property, if you are not going to have deferred maintenance on your house, then you're pretty much over the years, you're going to be almost building a new house every 50 or 60 years, right? So at some point, like all houses do, is fall apart. And every single problem a house can have requires money to fix. So if you're truly focused on keeping these properties in tip-top shape and fighting how brutal time is to these, and how these mechanicals just don't last forever, you're pretty much going to have to replace the house every 50 years. And I think if you were to take the entire cost, and I made a spreadsheet and it's available in most of the video's descriptions, called the capital expenditures calculator. And what I did was I essentially wanted to know how much I would need to put aside on a monthly basis in order to have enough money in an account every 50 years to replace everything in the house. So what I mean by that is, if a new driveway cost $8,000 and the driveway cost 50 years, then you would want to, 50 times 12 and then $8,000 divided by that number, and figure out how much money you need to set aside for a new driveway, so that when it runs out in 50 years from now, you would have enough money sitting aside. And if you do that for every single element that goes into a house, then that number is unfeasible for you to set aside on a monthly basis. And that is what causes me to insert this idea of quantity, right? So if you are collecting $10,000 a month across 20 doors, and that's $10,000 is after all of your expenses, like your mortgage payment, your insurance and taxes. If you just got 10,000 kind of free flowing cash flow, or whatever you want to call it, if that's your net, then chances are that $10,000 is going to be sufficient to cover any one item or any couple of items that go wrong with those 20 homes that you own. And I think that is the biggest element of being a real estate investor on a sustainable manner. When we had fewer than 10 properties, my brother and I, at the end of every month, we had like a very painful conversation of, hey, we each need to put in X amount of dollars in order to cover all the expenses for this month, right? And slowly that number got smaller and smaller as we got additional properties. And then once we were past that 20 property mark, very seldom have we ever had to put in our own capital. And the times that we have had to put in our own capital, it's been because of some, funny circumstances that have nothing to do with like the sustainability of the portfolio. Those are all my thoughts wrapped up into one.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.